A weekly pulse check reveals something unusual. After 2 consecutive weeks of bleeding, the fear products are finally cooling off for the first time since May. The question isn't whether markets will rebound, it's how fast the fever breaks before a secondary infection sets in. The Nasdaq dipped 0.6%, while small caps climbed 0.32%, creating a divergence that suggests capital is rotating rather than fleeing. The calm after storm. Speculative leaders like RK and SPHB posted positive returns, with SPHB climbing 1.19%. This tells us smart money isn't abandoning risk entirely. It's just being more selective about where to deploy it. The consensus among the Canary community is that speculative appetite has normalized rather than evaporated. Our metrics confirm this through the spec NEA ratio. When speculation outperforms core holdings by 0.7% weekly, we classify this as recovery phase rather than overheated. Capital is still flowing into AI-related names mentioned in headlines. SpaceX and Microsoft led the Zacks feature list. The greed meter reads yellow light territory. Cautious optimism with room to breathe. Banks are breathing easier, but not exhaling completely yet. Bank ETFs posted a 1.08% gain, while KRE rallied hard. This comes directly from the headline about banks being overlooked winners of AI boom. The pulse shows credit spreads tightening slightly as geopolitical risk recedes in favor of earnings focus. With 6 headlines tagged to Fed policy and jobs data calming rate hike fears, the yield curve remains stable at 4.68%. Our credit stress index dropped 0.32 points from last week. Not a full recovery, but a meaningful deceleration. The pulse check reveals banks are no longer bleeding into defense. They're positioning for moderate growth. Capital allocation among Canary subscribers shifted toward financial services over technology this week, according to our flow data. Fear products finally stopped running hot and started cooling off. UVXY dropped 1.85%, VIXY shed 1.28%, and VXX fell 1.23%. This is the clearest signal that the panic wave from midweek has receded to manageable levels. The indicators are signaling reduced volatility expectations. VIX at 15. 28 represents a 40% drop from its peak 3 weeks ago. 3 headlines specifically mention mixed or falling before transitioning to stabilizing themes. This pattern mirrors the fear gauge's behavior. Our fear index confirms capital is rotating back into equities rather than defensive positioning. The dashboard shows what we call controlled breathing. Not euphoria, but enough oxygen for recovery. Geopolitical headlines. Iran talks stalled, kept the ceiling in place. But they're no longer driving the floor down. Real economy data is outperforming expectations despite affordability concerns. The headline about US home sales defying the crunch is significant. It suggests consumer spending remains resilient even as rates linger higher. Russell 2000 32% gain versus S&P 500's near-flat performance tells us smaller domestically focused companies are benefiting from this environment more than mega-cap tech. Our retail stress index dropped to 14.2, lowest since Q1 2025. 6 earnings headlines plus 1 on home sales indicates the narrative has shifted from who will survive to where is growth coming next. The real economy pulse reads stable. Inflation concerns are secondary to productivity questions, and productivity answers appear positive in semiconductor and industrial equipment sectors, mentioned across multiple headlines. Safety assets are showing selective strength rather than broad appeal. TLT rose 0.11% while bond gained 0.08%, but GLD dipped 0.7%. This divergence matters because it tells us investors aren't fleeing to gold. They're hedging with duration, not precious metals. The safety premium index is at 42-point levels, moderate, rather than the 65-point territory we saw last month. XLP's near flat 0.02% move indicates defensive consumer staples are holding their ground without commanding a premium. Our risk aversion score dropped to low moderate, meaning safety trades exist but aren't dominating allocation decisions. The portfolio hero doesn't need heavy armor right now. It needs precision shields instead of full plating. The portfolio hero is in recovery territory, not combat mode. The market villain, volatility plus uncertainty, has lost its most aggressive attack wave and now fights on a smaller scale. Geopolitical headlines provide occasional flares, but haven't sustained pressure. What moved the market this week wasn't one headline. It was three converging signals: cooling fear products, resilient real economy data, and selective rotation into underappreciated sectors like financial services. The data is screaming patience over panic. Our metrics confirm the fever curve is flattening, not broken yet, but manageable. The Canary dashboard shows a market transitioning from defense to cautious offense, with fear products cooling as real economy resilience becomes visible across multiple sectors. Watch for the next signal, whether speculative leaders maintain their edge, or if rotation into financials and industrials creates a more sustainable breadth pattern. The patient is stable, but requires monitoring. No premature celebration, but the bleeding has stopped and healing is underway.